It's 7:14 a.m. You're scrolling through your 401k app over coffee, half awake, and something catches your eye. A new option you've never seen before, Bitcoin. Not on some sketchy exchange, not through a friend's cousin, right there, next to your target date fund and your S&P 500 index. Welcome to the new 401k. I'm your host, and today we're breaking down a rule change that could reshape how 65 million Americans invest for retirement. On March 30th, 2026, the Department of Labor dropped a proposal that sent shockwaves through the retirement industry. Not a minor tweak, a fundamental shift. For the first time, your employer's retirement plan could legally offer you cryptocurrency, private equity, hedge funds, assets that were once reserved for the ultra-wealthy. Sounds like opportunity, right? Maybe. Or maybe it's a trapdoor disguised as a ladder. The answer depends entirely on what you understand about what's actually in this rule. Let's back up. For decades, your 401k has offered a pretty standard menu. Target date funds, index funds, maybe some bond funds, company stock if you're feeling loyal. These are liquid assets. You can see their price every day. You can sell them whenever you want. They charge relatively low fees, sometimes as low as 0.03%. Alternative investments are different. Private equity might lock your money up for 7 to 10 years. Crypto can swing 50% in a month, either direction. Real estate funds don't trade on exchanges. Their value is determined by appraisals that happen quarterly, not by the minute. These assets play by different rules. The scale here is staggering. America's 401k market holds approximately $14 trillion. That's not a typo. 14 trillion. For private equity firms, that's the biggest untapped pool of capital on the planet, and they've been lobbying hard to get access to it. This all traces back to August 2025, when President Trump signed Executive Order 14333 and titled Democratizing Access to Alternative Assets for 401k Investors. The word democratizing is doing a lot of work in that title. The pitch is simple. Wealthy people have access to these investments. Why shouldn't regular workers? It's a compelling argument on the surface. Private equity has historically outperformed public markets. Diversification is investing 101. Why limit people's options? But here's where it gets complicated. The critics aren't saying these are bad investments. They're saying they might be bad investments for retirement accounts specifically. The DOL's proposed rule creates something called a safe harbor. It's essentially legal protection for plan sponsors, the people at your company who choose which investments to offer. Without this safe harbor, offering crypto or private equity could expose companies to lawsuits if those investments perform poorly. That's why most plans have avoided them. The safe harbor identifies 6 factors fiduciaries must consider when adding alternatives: performance, fees, liquidity, valuation, performance benchmarks, and complexity. Let's talk about those factors. Because if your plan does add these options, understanding this framework will help you evaluate whether they belong in your portfolio. First, fees. Private equity typically charges what's called 2 and 22% annual management fees, plus 20% of the profits. Let that sink in. Compare that to index funds charging 3 to 10 basis points. That's 0.03 to 0.07%. Over a 30-year career, that fee difference compounds into 6 figures. Here's something the industry doesn't advertise loudly. When researchers adjust private equity returns for risk and fees, that historical outperformance, it largely disappears. Second factor, liquidity. Unlike stocks you can sell in seconds, alternative investments often lock up your money. Private equity funds typically have holding periods of 7 to 10 years. That matters enormously for retirement accounts. If you need to retire at 62 because of a health issue, you can't wait until 69 for your private equity investment to mature. Third, valuation. How do you know what your investment is actually worth? With stocks, it's easy. Check the closing price. With private equity, you're trusting quarterly appraisals. Fourth, complexity. Here's what financial advisor survey by CNBC said, quote, Many 401k investors lack the knowledge to incorporate these sophisticated investments, which can be riskier and more costly. That's not an insult. It's just reality. Most people don't read quarterly reports for fun. They have jobs, families, lives. That's exactly why target date funds became so popular. Now let's talk about the elephant in the room, cryptocurrency. Bitcoin's inclusion in 401ks is perhaps the most controversial part of this proposal. Here's the honest truth about crypto volatility. A 50% drawdown is historically common for Bitcoin, not rare, not exceptional, common. Imagine you're 58 years old, 7 years from retirement. Your 401k has crypto exposure, and over 3 months, that slice loses half its value. Can you stomach that emotionally? More importantly, can you afford it financially? The math changes dramatically when you're drawing down rather than building up. The crypto industry has also had significant fraud issues. Billions have been lost to scams, hacks, and exchange collapses. FTX alone wiped out customer funds worth over $8 billion. Now, I want to be careful here. I'm not saying crypto is inherently bad or that you should never own it. What I'm saying is your retirement account might not be the right vehicle for it. Here's the framework that might help you think through this. What percentage of your retirement can you afford to lose entirely? Not draw down temporarily, lose permanently. For most people approaching retirement, that number is very small, maybe 5%, maybe less. And if that's your risk budget, it probably shouldn't all be in one volatile asset. Let's step back and talk about who's really pushing for these changes. Because understanding the incentives helps you evaluate the advice you're getting. Private equity firms manage trillions in assets, but they've largely been locked out of the 401k market. This rule opens that door. Their lobbying efforts have been, let's say, robust. The crypto industry has its own motivations, legitimacy, mainstream adoption. A $14 trillion market validating their asset class would be transformative for them. That doesn't make their arguments wrong, but it does mean you should consider the source when evaluating claims about how these investments will benefit regular workers. The final rule is expected by the end of 2026, according to Gibson Dunn's analysis. After that, plan sponsors will begin evaluating whether to add alternative options. So what does this mean for you, practically speaking? Probably nothing yet. The rule isn't final. Even when it is, your employer may choose not to add these options. But if and when alternatives do appear in your 401k, you might want to consider a few things before clicking that allocation button. First, don't feel pressured to invest in alternatives just because they're available. The traditional stock and bond mix has built retirement wealth for generations. It still works. Second, if you're tempted by higher potential returns, you might want to look carefully at the fee structure first. Remember that 2 and 20 I mentioned? Run the numbers over your timeline. Third, consider consulting with a fee-only financial advisor before allocating any portion of your retirement to alternatives. Note the fee-only. They don't earn commissions on what you buy. Understand the liquidity constraints. If you can't sell an investment when you need the money, that investment might not belong in your retirement account, no matter how attractive the projected returns. Here's something I want you to understand about retirement investing. Your situation is specific to you. Your risk tolerance, your timeline, your other income sources all change the math. A 30-year-old with decades to recover from volatility has different options than a 58-year-old counting down to retirement. One size does not fit all. Proponents argue alternatives could provide greater diversification and potentially higher returns away from public markets. And historically, for sophisticated investors, that's sometimes been true. But sophisticated investors typically means people with teams of analysts, lawyers, and accountants evaluating every deal. Do you have that support structure for your retirement account? That's not condescending. It's just honest. Even full-time investment professionals get these calls wrong regularly. The idea that a school teacher or nurse will nail alternative investing in their spare time is optimistic. Now, your situation is unique, and you should verify any decision with your own advisor. But what the historical pattern suggests is that most investors are better served by simplicity than complexity. A 60-40 portfolio, 60% stocks, 40% bonds, lost 16.9% in 2022, its worst year since 1937. But investors who held through recovered fully by November 2023. Investors who panic sold in October 2022, they locked in those losses permanently. The boring strategy, holding steady, outperformed the clever strategy of trying to time it. I've been thinking about this a lot lately. The financial industry loves complexity because complexity justifies fees. Simple index fund? Hard to charge much for that. Hedge fund with proprietary algorithms? Now we're talking. Look, I'm not saying everyone in finance is trying to separate you from your money. But I am saying, when evaluating advice, always ask who benefits from you following it. Before your plan adds any alternative investments, consider asking your HR department or plan administrator these questions. What are the total fees? What are the liquidity terms? How is the asset valued? If they can't give you clear answers, that tells you something. Legitimate investments can be explained simply. Complexity is sometimes a feature, but it's often a bug. Here's the honest version. Nobody, not the DOL, not Wall Street, not your favorite finance podcast, knows exactly how this will play out. What we can do is look at what the data has shown historically, with the full understanding that history rhymes more than it repeats. Past performance doesn't predict future results. You've heard that disclaimer 1,000 times. It exists for a reason. Every asset class that seems unstoppable eventually stops. If you found this breakdown helpful, consider subscribing. We cover these kinds of regulatory shifts and what they mean for your money every week. It's how you stay informed without reading every financial document yourself. So let me bring this back to where we started, that Bitcoin option appearing in your 401k app. What should you do when you see it? My suggestion? Take a breath. You don't have to decide immediately. The option being available doesn't mean the option is right for you. Read the disclosures. Check the fees. Consider your timeline. And if you're unsure, a conversation with a fee-only advisor could be worth every penny. Your retirement isn't a game to experiment with. It's money you'll need to live on when you're no longer working. Treat it with the seriousness it deserves. That's the story of the DOL's alternative investment proposal, what it says, who's pushing for it, and what it might mean for your 401k. We'll be following this as the final rule develops and keeping you informed on what it means practically. Until then, make smart moves and protect what you've built. This content is for educational and informational purposes only and does not constitute financial advice. Always consult with a qualified financial advisor before making investment decisions. I'm your host. This is Money Moves Daily. Remember, this content is for informational purposes only and is not financial advice.